Hey, what's up guys, this is Ian, welcome back to Show Me the Money. As many of you may know, in the market, many brokers offers the opportunity to sell a stock. For this to happen, the broker lends you a stock of a determined value for you to go to the market and sell it, hoping it will decrease in value in the future to then buy it again and return to the broker, making a profit in the process. It may seem complicated theoretically, but it's in fact very simple. Instead for opening the position in buying, you open the position in sell, no matter the broker you're using. Today, I'm gonna share with you 3 stocks I used to have a couple of months ago on my portfolio, but after reviewing some fundamentals and reports, I closed my position on them due to what seems to be an inevitable collapse: Uber, Virgin Galactic, and Zoom. We have to remember that opening a short or sell position is way much risky than buying a stock, and I will really recommend this for mature investors, mainly for 2 reasons. First one, your potential benefit is limited to 100%, but your potential loss is unlimited. Stocks can grow 2, 3, 4 times its price, but can go below 0. And the second one, the cost of selling a stock. If this stock is paying dividends, you will be the one who will have to pay these dividends to the lender. Besides, your broker will charge you for lending this stock a certain interest that may be annual or even monthly. These 2 factors makes time play against you. The more the stock takes to go down as you expect, the higher this cost will be for you to maintain your position. And it is not uncommon that investors that are right about the future of a stock ends up losing money just because they were not able to maintain their position long enough. The first stock I sold is Uber. Uber trades in the New York Stock Exchange with the ticker UBER, right now at around $30 per share. I opened my position in Uber at $28 in October 2019 and closed it early this month at $32. After years of extraordinary growth, Uber launched its IPO on May 10, 2019, one of the most hyped financial events since Facebook went public in 2012. The 2 reasons that pushed me to sell Uber have to do with the new regulations introduced to prevent the company taking advantage over the low-cost workers and the low profitability of the company. We can check over the annual reports that even when Uber have grown a lot in sales over the last 5 years, their losses has also grown exponentially to the point of losing more than $8 billion last year. Uber reported larger than expected losses for its second quarter, even as revenue beats analysts' estimates. This is due to the 75% drop in gross bookings for its rides segment and the doubling of gross bookings for its Eat segment. Both the decline and the rise were greater than what analysts had expected, and Eats has, at least temporarily, replaced rides as Uber's largest segment by sales and gross bookings. In fact, even when the market still doesn't know when or how much Uber is going to produce profits, their market cap is over $55 billion, a valuation comparable to companies like Goldman Sachs, General Electric or Activision Blizzard, and over companies like Honda Motors, PNC, eBay or Dell. The second stock I would like to analyze is Virgin Galactic, which also trades in the New York Stock Exchange with the ticker SPCE, at around $70 per share. This one, in fact, is the only one that I actually never bought, but opened a sell position in February this year at $28, which I still maintain to this day. The company depicts the ambitious projects of the famous entrepreneur Richard Branson. They aim to become the first spatial tourism company, but first, they are focusing on suborbital space flights, where clients will be able to experience zero gravity for a couple of minutes. However, the real space flight seems to be still very far. Obviously, the potential market for this kind of service is massive, but it have to be at the right price, and Virgin Galactic pretends to charge $250,000 for these suborbital flights. They have been losing more than $200 million each year. They have been accepting reservations since 2004, but of course they're still not having any incomes, and in 2014 they suffered a major setback when one of their test pilots died in a crash. Events like this are very dangerous to the company, especially because they depend heavily on maintaining their stock price high enough to issue shares in the future and be able to finance their growth plans. To understand what's the real growth in the reservations of this company, we have to check in the balance the customer deposit row, where is shown the reservations that clients have done, so you can compare the performance from last year's to this one. Checking this, we realized that client deposits have grown only 83 millions from 80 millions of last year, a ridiculous growth taking into account the market capitalization of the company that is above $4 billion. According to their balance sheet, they have more than 400 millions in cash. The problem here is that the annual cash out is around 250 millions, leaving them with a year and a half of liquidity. Then they will be forced to issue more shares. The third company to sell is Zoom Communications. Zoom trades in Nasdaq at around $288 per share right now with the ticker ZM. I sold Zoom last week for $265 each share after opening my position in early March at $120 per share. The stock has rocketed higher in 2020, underpinned by the current illness, which has forced many businesses around the world to send home employees and switch to video conferencing. While this paradigm shift should generate a permanent increase in revenues, total eyeballs could drop as many folks go back to work at physical locations as the illness becomes relatively controlled and vaccines are closer each day. Americans and Europeans are slowly heading back to physical workplaces, reducing the need for conferencing services. As we have seen with other companies that benefited from the shutdowns, market players have been dumping shares after first and second quarter releases, and transitioning capital into beating down companies that have gone relatively cheap due to the first quarter revenue destruction. With a price-to-earnings ratio over 1600 and a market capitalization over $80 billion, Zoom stock price seems completely unsustainable and very exposed to any fundamental success that can take it back to reality. However, we have to be reasonable too and understand the solid foundation on which Zoom lies. This can actually take the stock even further from where it is now, especially in the short term, when second quarter's results are published and almost certainly will blow analyst expectations. Guys, please remember, these are just analysis examples to help you understand how can we correctly value companies, and that going short on a stock is a very high-risk operation that have to be analyzed very deeply and carefully. So that's it for today, guys. I hope you enjoyed this video, and if you did, please share and hit the like button, and see you in a couple of days.